I get this question a lot from newly promoted Big Law partners. Why do I feel broke? I just got the biggest promotion of my life. Well, the answer lies in the way the IRS now sees you, a true business owner. You're no longer considered an employee. You're now a self-employed individual, just like if you own that coffee shop around the corner from your office. And that has implications from a compensation, tax, benefits, and cash flow standpoint. If you're new to the channel, I'm Joel. I'm your Big Law money guide. I'm married to a former Big Law attorney, and I've educated hundreds of attorneys on the topics of personal finance. So hit that subscribe button if you want to make smarter financial decisions. All right, let me show you what I mean. So why do newly promoted Big Law partners feel broke in the first couple years after the transition? Well, there are a variety of factors. The first one is quarterly estimated tax payments. So as an associate, taxes were withheld from your paycheck and remitted to the IRS on your behalf. Now, as a partner, taxes are no longer withheld, and it's your responsibility to remit your taxes to the IRS each quarter. So that means that you have to keep a portion of each paycheck to send to the IRS at a later time. You also have to deal with the self-employment tax. So as an associate, you are paying half of the Social Security and Medicare tax. Now, as a self-employed individual, you're technically the business owner, so you have to pay both the employee and the employer side of the Social Security and Medicare tax. That's called a self-employment tax, and it raises your tax liability. Next, you have the multi-state tax filing. Because you're an owner of the firm, you share in the profits of the firm in all the states where the firm operates. Well, that means that you have to pay your share of the tax liability in those states. So you have to file taxes in multiple different states. Also, as a partner, since you're now the owner of the firm, your benefits are no longer subsidized. Think about it. You'd be kind of subsidizing your own benefits, so that wouldn't make sense. So your benefits are going to cost more money. And lastly, you have the mandatory profit sharing and cash balance plan contributions. Now, income partners may only have to do the profit sharing part, but once you become an equity partner, you're more likely going to be mandated to contribute to the cash balance plan as well. So between the two of you, you can expect an additional between $60,000 and $70,000 per year that you have to put in to those retirement accounts. Now, it's not like that money is lost forever. You'll see it back one day in retirement, but for a 35, 40-year-old partner, that's a long time, and it impacts your cash flow today. So to show you the impact that these changes can have on your take-home pay, I put together a comparison between a senior associate and a junior partner take-home pay if you factor in all of those changes. So as you can see here on the screen, the difference is about $60,000 less in your pocket as a junior partner than as a senior associate. And that's even after getting a $15,000 raise as a result of the promotion. So no wonder why some partners feel broke after transitioning to partner. So in this video, I'm going to show you 3 things that you can do to mitigate the impact of these changes on your cash flow. By the way, if you want to dive deeper into each of these changes, you can sign up for my free partnership transition course by going to the description below. As an associate in Big Law, your taxes are pretty simple, and you can probably get away with doing it on your own with TurboTax. But as a partner, your taxes have become much more complex, and you must work with a qualified tax professional. So what are the keys to finding a good tax pro? Well, let me show you. First, you want to find a tax pro that will not only do tax preparation, but also tax planning. The difference is that tax preparation is just gathering your documents and filing your tax return on your behalf. The analogy I like to use is you're looking in the rearview mirror. You look at what happened in the past year, and then you file the taxes. So you kind of deal with what happened. Tax planning is taking a proactive approach and making changes before the end of the tax year. So I'll give you an example. If you are in Q4 and you do a little bit of tax projection, you may realize that you're going to be short with your tax payments for the year. So you can make an estimated payment in Q4 in order to minimize your tax penalties. So that's an example of a short-term benefit of tax planning. You can also have long-term tax benefits of tax planning. For example, the recommendation of doing a backdoor Roth IRA for a Big Law attorney could have over $100,000 tax benefit over your lifetime by just simply shifting your assets from one bucket to the other. Now, keep in mind that a good tax professional will cost you more than your TurboTax software will. You can expect to pay between $2,500 and $5,000 per return depending on where you live and the complexity of your return. So if you have a spouse who is a business owner or something like that, that may increase the cost. And if you're lucky enough to work with a good CPA and a financial planner who understands your cash flow, then that's the ticket. Because your financial planner will have a deep understanding of your goals and your cash flow, and they can talk to your CPA and make recommendations on how to reduce taxes now and later. A good example would be if you want to make a charitable contribution before year end to reduce your tax burden. Another benefit is that your financial planner typically has all the tax documents or most of the tax documents that you'll need to prepare your return. And they can send those to your CPA, saving you valuable time. At the end of the day, a good tax bill will cost you more, but trust me, it's going to be worth every penny, especially considering that you could pay thousands of dollars in underpayment penalties if you mess up your taxes. If you need a list of vetted accountants who work specifically with big law attorneys, just reach out to me either on LinkedIn or on Instagram, and I'm happy to send it to you. All right, the second strategy to mitigate the impact of the transition to partnership is to create a savings account that is earmarked for taxes. When you're a big law partner, it's one thing to know your tax liability each quarter, but it's another thing to actually have the cash on hand to make those quarterly payments. Remember, as a partner, your taxes are no longer withheld from your paycheck, so it's your responsibility to remit those to the IRS each quarter. That means that some of the money that you receive from your draws and your distributions and your bonus is not all yours. A good chunk of it is the IRS's. So how do you make sure you have enough money saved each quarter to make those payments? The answer is to have a tax savings account. So what I typically recommend is that you get with your accountant and that you determine a set percentage or dollar amount that you're going to send to that tax savings account each time you get paid. So if it's 35%, 40%, you send that automatically to your tax savings account. And I highly recommend that you automate this process so that you don't forget, or at some point, if you end up spending too much money and you don't have the money to transfer. And when the payments are due, you just pay straight out of that tax savings account. So it's money out of sight, out of mind, just kind of like if you had withholdings on your paychecks as an associate. But that said, even with the tax savings account, you still have one big issue that comes up usually around the second quarter of the year, which is April and May. So in Q2, you only get about 15% of your income for the year, right? You only get 2 months worth of draws and 2 months worth of distributions. But most accountants will recommend that you make 4 equal payments throughout the year for your tax liability. So that's 25% of your tax liability each payment. So you can see the discrepancy there. You get 15% of your income, but you have to pay 25% of your tax liability. That usually creates a cash flow crunch. So the way around that is to pre-fund that tax savings account at the beginning of the year with at least 1 quarter's worth of taxes. That way you're always ahead. And for big law attorneys, since you get a bonus that's pretty large at the end of the year, you can use your bonus to pre-fund that tax account. And then lastly, I recommend that you use a high yield savings account for that tax account. Might as well get a little bit of interest while that money's sitting there. All right, so the last strategy we'll discuss is not really a strategy per se, but it's something that I recommend that every new big law partner goes through before the transition. And that's reviewing your personal cash flow. If I told you you'd be taking home 15% less income as a junior partner than as a senior associate, you probably wouldn't believe me. But unfortunately, that's the case for many big law attorneys making the transition. That's why it's crucial to have a really good understanding of your personal cash flow. And the best way to do that is to map out your cash flow through a conscious spending plan. There are 5 steps to doing that. First, you want to start with your gross monthly income and only include guaranteed pay like your draws. Or you can also include like minimum distributions that you can expect or minimum bonus, but don't include anything that's you're really not expecting to get. Next, you need to work with your accountant or your financial planner to determine your tax liability as well as your benefits costs. At that point, you get your true net take-home pay. From there, you want to deduct your savings needed for the year. I typically recommend saving about 20% of your gross income. So if you make $500,000 a year, that's $100,000 that you would need to save each year. Now, $100,000 might sound like a lot of money, and it is, but don't forget that you have the $46,000-ish profit sharing contribution that's mandatory If you're an equity partner, you may have, $20,000, $30,000 mandatory cash balance plan. Then you have your employee 401k, HSA, Roth IRA. So you can get up to 100,000 pretty quickly. From there, what's left is for you to spend for your expenses. And those are split into two buckets. You have your fixed expenses. So think about the things that don't really change much from month to month, right? Your normal bills like your mortgage, utilities, car payments, daycare, tuition payments, things like that. And then what's left, you get to spend it guilt-free on whatever you want. So going through a conscious spending plan will allow you to determine whether you have a surplus or a deficit at the end of the month based on your new compensation structure. If there's a surplus, good for you. You can maybe spend a little bit more in that guilt-free spending bucket, or maybe save a little bit more too. If there's a deficit at the end of the month, then you're gonna have to look at your fixed expense bucket and your guilt-free bucket and see where you can cut back, because that's not a sustainable thing long-term. Look guys, I know this may sound demoralizing for new partners, but trust me, your income trajectory as a Big Law partner will far outpace the little setback that you have in the first couple years after making the transition. So as you adjust to this new reality, there are two things that you can do. Number one, you can temporarily cut back on savings. Like I said, there will be a mandatory profit sharing contribution, potentially cash balance plan. So you're going to be saving a lot of money. So it's okay if maybe you reduce some of the other savings that you were doing in the past, like maybe to a brokerage account or to a Roth IRA, or even the employee component of the 401k that's not mandatory. So it's okay if you temporarily reduce your savings as you get adjusted. Now, don't get used to it. Long term, again, you want to save 20% of your income. Number two, maybe try to cut back on some discretionary spending. Maybe you don't take that big trip that you normally take every year, or maybe you spend a little bit less on shopping for that year, just as you get accustomed to your new income. Like I said, your income trajectory will far outpace the little setback, so you'll be able to get back into those spending habits that you had prior. All right, guys, so as I wrap up this video, if you're approaching this transition to partner and you need guidance on navigating these changes so that you can focus on your life and your career as opposed to becoming an expert in all this, I've included a link to schedule a free introductory call with me below. So thanks for watching and hope to see you in the next video.